Happy New Year, and welcome to Power Up Little Rock. My name is John Burgess, and I have the honor of serving as this year's Chairman of the Board of the Little Rock Regional Chamber. We're excited to continue our Power Up series today with a topic that is on everyone's minds these days, the U.S. economy and monetary policy. Since the Chamber launched Power Up, more than 750 business leaders have had the opportunity to engage on some of the most important economic and business issues facing our region, including the economic outlook, healthcare, education, and manufacturing. You are going to hear much more from our speaker about the state of the U.S. economy and monetary policies in our region, and will be able to send questions throughout the presentation. Our Q&A session will be moderated by our Chamber CEO and President, Jay Cheshire, after the presentation, so go ahead and start sending those questions through the Q&A option in Zoom. Before we get started, I would like to thank our key Power Up partners. First, Delta Dental of Arkansas is our series partner sponsor. Please join me in thanking them for their investment. And our Power Up series is presented by Arvest Bank. The success of this event would not be possible without the significant support of the team at Arvest, which has had a critical role in shaping the topics and the tone of this series. So now, please join me in thanking and welcoming to the stage President and CEO of Arvest in Northeast, Central, and Southwest Arkansas, Mr. Jim Cargill.
Happy New Year. Thank you, John. I appreciate the introduction. We're certainly glad to be here celebrating a new year together, and we are excited at Arvest to be able to continue and resume the Chamber Speaker Series Power Up. We enjoyed our sponsorship last year, and we're really excited about continuing this year. Before we get on with today's program, though, I would like to take a moment to celebrate a huge win that took place for the Chamber and for Arkansas during the year 2020. Most of you are probably familiar with the Ford Next Generation Learning Model the Little Rock Regional Chamber has supported implementing in the 4 school districts here in Pulaski County for nearly 3 years now. Working in conjunction with educators and business professionals in various industries, this educational model creates a new curriculum with new connections for high school students to learn about career options and to begin to pursue their interest while learning core academics in a more relevant environment. We have named the local initiative the Academies of Central Arkansas. Despite the many challenges of 2020, I'm proud to share with you that a new freshman curriculum is in place, and the inaugural freshman class of the Academies of Central Arkansas took part in Freshman Seminar, where students gained exposure to various career fields and actually declare which area of study they want to pursue throughout high school. 4 public school districts and 5 chambers of commerce in Pulaski County have collaborated to transform education through career exposure, industry mentors, and hands-on experiences for students. In the spring of 2024, we will celebrate the first graduating class of the Academies of Central Arkansas. So thank you and congratulations, Chamber and members, for your investment in our students and in our new future workforce. Now back to Power Up. Yes, 2020 did bring us challenges from a lot of different directions, but the work was begun and progress has been made to identify economic development opportunities for Central Arkansas. This time last year, we were fortunate to host Mr. Jim Bullard, President and CEO of the Federal Reserve Bank of St. Louis. Jim shared his knowledge regarding the U.S. economy and monetary policy with us at that time. Today, we are honored to have Jim join us again to discuss the same topics. I would venture to say that his insight would be of interest to just about every Arkansan and perhaps every American right now. At the end of the program, you will have the opportunity to ask questions of Mr. Bullard. As President and CEO of the Federal Reserve Bank of St. Louis, Mr. Bullard oversees the Federal Reserve's 8th District, which includes branches in Little Rock, Louisville, and Memphis. He participates on the Federal Reserve's Open Market Committee, which meets often to set direction of U.S. monetary policy. Mr. Bullard is an economist and scholar and is often an early voice for change. He regularly engages with many audiences, including academics, policymakers, business and labor organizations, and charities, among other groups, to discuss monetary policy and to help further the Regional Reserve Bank's role of being the voice of the people. A native of Forest Lake, Minnesota, Mr. Bullard received his doctorate in economics from Indiana University. He holds Bachelor of Science degrees in economics and in quantitative methods and information systems from St. Cloud State University. Mr. Bullard, we are honored to have you join us again this year. I'll turn the meeting over to you.
Well, thanks very much and Happy New Year to everyone. Thanks for having me again this year. It's always a pleasure to talk to this group, and I'm looking forward to your questions and feedback on my view of the U.S. economy, which I'll get into here. It's been a tough year in 2020. We're entering a new year. So I titled this talk, The Pandemic Endgame Begins. And I guess my overall message would be that, it's not over yet, but you can see the light at the end of the tunnel at this point, and hopefully we'll be able to execute our way out of the pandemic at this point, get back to healthier economy and better public health situation. So the key themes here will be that the pandemic has definitely worsened, and I'll show you a chart about that, but that the early arrival of vaccines suggests that the health crisis is going to come to an end in the months ahead. I'll show you a chart about that as well. I'm going to stress that U.S. monetary and fiscal policies have been quite effective during 2020. We'll have lots of charts about that. I also think that the fiscal response, both the monetary and fiscal response, but especially the fiscal response, was designed for a bigger shock than the one that occurred. And we can talk about that some. If you look at what's going on right now in the U.S. economy in the quarter that just finished, the fourth quarter, it looks like tracking forecasts are for a pretty strong fourth quarter. We'll see if that actually pans out. So we'll take a look at that. And as always in a crisis, you don't know what's just around the corner. So these things can take twists and turns. There are downside risks that remain. I'm not going to talk about them a lot here. We can do it in the Q&A. But you need this continued execution of a granular risk-based health policy in order to work our way through the rest of the pandemic here. So let's go to the next slide. So this section is about the health crisis worsening, but why it's expected to wane. So let's go there. Next slide. So like any crisis, you have to have daily management around the health crisis. And the main thing that's happened in the last 6 to 8 weeks is that daily fatalities per 100,000 population have increased both in Europe and in the US. For East Asia and Pacific, they are really experiencing something completely different from the US and Europe. I'll show you a chart here in just a minute, but it's really a very different situation there. So if we think of the main production areas in the global economy, Europe, US, and Asia, it's really the Europe and US that have been the most affected here. Let's go to the next slide. So this is the chart that I like to use to give a broad picture of what's happening day to day with the pandemic. And I know it's a little busy, but we'll spend a little bit of time on it here. The main message is that the health outcomes are worsening. This chart starts on the left-hand side in the March timeframe and goes all the way out using daily data up to our currently available data into January here. The vertical axis is a 7-day average of deaths per 100,000 due to COVID. And you can see the gold line here is Europe, defined as France, Germany, Italy, Spain, and the UK. And the blue line is the US. I like to compare those two entities because population It's about 321 million for those 5 countries, and it's about 330 million for the US. So you're kind of comparing apples to apples as far as the size and complexity of the economies. The green line is East Asia and Pacific, including China. And then the horizontal lines here are meant to give some kind of benchmark about mortality risk in the US. The dotted gray line there toward the bottom is the accidental injury deaths on average during 2018. So a little more than a 1.5 per day per million. The dash dotted blue line is cancer deaths, a little over 5 per day per million, it looks like on this chart. And then the dotted gold line there is a horizontal line is heart disease deaths, leading cause of death in the US. So those are some benchmarks about how intense the pandemic has been at various points in time. And you can see the blue line and the gold line squiggle all over. That's because the pandemic reaches higher intensity at some points and other points. So I have lots of points to make about this, but I'll just run through them here. If you look on the left part of the chart in March, April timeframe, that gold line peaks at about 10 deaths per day per million, or 1 death per day per 100,000 due to COVID. So Europe was really hit the hardest here. And I think that's really the point at which the crisis was the most intense, and you got the most reaction to it at that point. US about 6.5 per day per million at that point. And then both lines come down. You can see that the Europeans got their death fatalities per day per million down close to 0. But there was more persistence in the US, and the crisis did get more intense in the US during the July, August, September period. Now, another point about this is that green line there, which is East Asia and Pacific, is barely registering anything on this sort of scale. They're actually close to 0 the whole time. So they're experiencing something very different from the US and Europe. My speculation is that there's more natural immunity in East Asia because they've had more corona, probably ones that we don't even know about, milder forms of coronavirus that have created natural immunity somehow over there. We don't have the science behind that at this point, but I suspect that will be studied intensely in the years ahead. But the point is that that part of the production piece for global production is very different from the US and Europe. And then when you get over on the right part of this chart, which is the November, December, January timeframe, you see that the fatalities per day have again increased in the US, surpassing the previous March, April peak, and in Europe also quite high. So this is the situation that we're in right now. So all by itself, this chart would seem to indicate, the red circle there would seem to indicate that the US economy is not going to do very well, because it certainly did not do very well in the March, April timeframe when the pandemic was just coming upon us. But I'm going to disabuse you of that notion. That isn't really what's how to think about what's happening. So let's go to the next chart here. So what's happening is that vaccines have arrived, as we're all well aware of, and I would say they arrived a good 9 to 10 or 11 months ahead of commonplace predictions of when they would come on the scene. And those vaccines are being administered as we speak. And this is the projection for fatalities from COVID that's due to the Institute of Health Metrics and Evaluation at the University of Washington, Seattle. So that peak there in this picture is actually, if I recall correctly, is January 11th, just a few days from now. And then it's expected to go down steadily from there. So this declining fatalities through February, March, April is going to lead to much less intensity of the crisis, and it's going to allow us to bring this crisis to a close. Let's go to the next slide. Now, many people say, well, you know, the fact that the crisis, the health part is more intense means that business restrictions will get more intense. And so let's look at actual data on business restrictions. This is a metric put together by the University of Oxford in England across countries. The dotted line there is China, UK, Japan, Germany are on here. The dark blue line is US. And this goes back to the first part of 2020 on the left-hand part of this chart and comes all the way out to the current, the most current data that we have, January 2021. So the point of this picture is that before the pandemic started at January 2020 there, this index is down at 0. And when the crisis came along, these indexes all went up to about a 75 or 80 on this scale. And they really haven't moved very much since then. So the part that caused the big downturn was the big upswing from 0 to a 75 on this scale. And then not much has happened. When you get over to the November, December, January timeframe and you look at this picture, you're really not seeing any differences, you know, except for minor ones in the amount of business restrictions. So that's why you're not really getting the big kind of sweeping downturn that you saw in March, April, even though the health crisis has become more intense in the December timeframe of 2020. So yeah, you can see on the right-hand part of this chart, many countries have increased somewhat their business restrictions. Even China is higher, but really not too different from what it's been the whole time since March, April. Let's go to the next slide. Another factor to keep in mind is that as we're administering these vaccines is that the fatalities are very much skewed toward older citizens. This is a benchmark picture that we can use to assess that. It has different age groups on the horizontal axis, starting with young people on the left and older people on the right. And the death rate per 100,000 is given on the vertical axis. So I like to benchmark this against accidental injury deaths based on 2018 data, the gold bars here. And what you can see is that for the over 75 group, they faced more risk from COVID, the blue bar there, than they do from kind of ordinary accidental injury risk. Accidental injury includes car accidents, but also all kinds of other accidental injuries that occur every year in the US population. So for the over 75 group, they're more at risk from COVID. In fact, from the 65 to 74 group, they're also more at risk from COVID. But when you get down to the under 45 group on the left-hand part of this chart, you see that those groups are facing less risk from COVID than they would from a benchmark mortality risk like accidental injuries. So this is, of course, bad news for those that are the most vulnerable, and we all know people that have been affected by this human tragedy. But it suggests that we are going to be able to target our vaccine approach toward older Americans, and we're going to be able to reduce the fatalities fairly quickly. And so hopefully that will occur in the months ahead here. Let's go to the next slide. So that is what's happening. Vaccine distribution is being distributed to those most vulnerable. So that suggests that the crisis can come under control in fairly quick order here. The business restrictions are not that different today than they have been. So there's really no change or very little change on that. You might say, well, where are the extra infections coming from? I think that's coming from personal interactions at the household level. That's very difficult to control. And so I think that's what led to the increased intensity in the public health situation. And finally, I think for many businesses, including many of your businesses, learned to operate in an environment, in a pandemic environment, and still produce most of their goods and services. So that's what's driven most of the growth that we've seen in the second half of 2020, and we'll probably continue to see in the first half of 2021. It's just the ability of businesses to adapt. Not every single business can adapt, but many have adapted very, very well. So let's go to the next slide. Okay, so let me just talk in this section about monetary and fiscal policy. Let's go to the next slide. For monetary policy, we lowered the policy rate to the effective lower bound again, and we had a number of programs that provided liquidity to financial markets through a variety of programs supported by the U.S. Treasury. I think it's very clear, and history will mark down that the Fed prevented a financial crisis that could have occurred on top of the pandemic in the March-April timeframe. And we can see that in the next chart, which is about financial stress. Let's go to the next slide. So this is the St. Louis Fed's Financial Stress Index. 0 would represent a normal value of financial of stress that's associated with kind of ordinary financial markets. You can see this blue line here. This goes all the way back to 2018 to give you an idea of some of the fluctuations in this index. This index includes things like the VIX and corporate credit spreads and so on. So when you got to the March-April timeframe, the vertical line in this picture, this index had gone all the way up to levels that were consistent with 2008, which was one of the biggest financial crises we've seen in our lifetimes. So there was very much a risk that you would get a financial crisis on top of the pandemic. But with the introduction of those programs, financial stress went way down, and in fact has been for the last half of 2020 and into 2021 has been at low levels that are consistent with the normally operating economy. So I think we averted financial crisis this time around, and hopefully we'll be able to get all the way through the pandemic here without further increase in financial stress. Let's go to the next slide. The fiscal policy response has also been very aggressive. We had the CARES Act along with other legislation valued at about 3.1 trillion or so. The actual shortfall in US GDP, according to forecasters during 2020, looks like it'll only be about 2 to 2.5% of GDP, or about $400 to $500 billion. So $3 trillion response to a $500 billion shortfall in GDP. Now, you might wonder, well, why did that happen? I think at the time the legislation was passed, the idea was that the crisis could be quite a bit more severe, something more like 10% of GDP or 12% or 15% of GDP even, plus there was downside risk. So I think Congress definitely wanted to do as much as they could to avoid that kind of outcome. Now, what has happened is that the fiscal response has driven personal income up to an all-time high in the second quarter, which is the exact opposite of normal recession dynamics. Usually when a recession comes along, all of our incomes go down, and that's why everybody's mad about the recession. But here, real disposable income actually went up and actually remains above the trend pace that would have otherwise occurred. In addition to this, we have an additional Consolidated Appropriation Act of 2021 signed into law just now on December 27th. That has an additional $900 billion in pandemic relief. So we're up to $4 trillion in pandemic relief so far. So let's go to the next slide. So here's a great picture that I want to dwell on a little bit. This is real disposable personal income. And this goes back to January of 2019. So it shows you the previous 2 years. And the gold line there just takes the trend from 2019. And these are just in nominal dollars. So the vertical scale is just trillion or billions of dollars. And this trend line is what I want you to think about is the benchmark policy. The benchmark policy is you want to keep households whole when the pandemic comes along. They've been disrupted. We go to them and we say, hey, we're very sorry, but you're not going to be able to work during this pandemic. We've got a public health problem. But don't worry, we'll keep you whole during this period by borrowing money on international markets and handing it out to disrupted households. That's what the gold line represents. Is the goal is to keep everyone whole, keep their real disposable personal income where it would have been had there been no pandemic at all. That's what the gold line represents. Now the blue line looks at what actually happened here, which is that real disposable personal income actually skyrocketed after the CARES Act was passed and has remained above the Keep Households Whole policy line this entire time. And in addition, the IHS market forecast as of January 4th, which is the red dots here, suggests that this will continue to be above the Keep Households Whole policy line all the way out into mid-2021 with the new package that has occurred. So you've done more than just keep households whole. You've kept them more than whole. Now, there's a lot of dispersion here. Of course, you can identify households that didn't get anything or didn't get the proper amount, and that's an issue about not allocating the resources around in the right way. You can also identify households that got more than they should have because they weren't really disrupted by the pandemic. But the point is that in the aggregate, there seem to be plenty of resources here, and that certainly bodes well for the U.S. economy in the first half of 2021. So let's go to the next slide. This is another chart that I picked up out of by Irwin and Kai at the New York Times. This was published on the 1st of January here. So this is another way to tell the same story. This is their chart, not mine, and their comments here are theirs, not mine. But if you look at the red part there, that's the wages and salary. What they did was compare 2020 versus 2019 during the same time period. So you're looking at numbers that are changing personal household income from what it was in 2019 to what it was in 2020. And the basic point of this graph here is that it's about $1 trillion higher in 2020 than it was in 2019. How could that possibly be? We're in the middle of a pandemic, but they show you why this is. The wages are down compared to 2019 and 2020, but they're only down, that's a big number, 43 billion, but they're down 43 billion. And then Congress responded to this with extra unemployment insurance benefits. It's about 500 billion with stimulus checks, about 275 billion, additions through the PPP program that helped out proprietors' income, another 29 billion, other income accounting for even more. So then you get up to about $1 trillion more in real disposable personal income than you would have had in 2019. So a lot has been done here is the main point. So let's go to the next slide. So the U.S. recovery is far ahead of schedule. One of the ideas that many people have is that, we had a financial crisis in 2007 to 2009, and it's going to take a long time to recover because it took a long time to recover last time around. But that isn't the right way to think about this at all. We're way ahead of where we would have been in recovering from the global financial crisis. So let's take a look at that in this next section of slides. There's, first of all, the US economy obviously declined in a great deal in the second quarter, but then third quarter real GDP growth at an annualized rate of 33%, the economy came exploding back, the fastest growth rate on record. And for the fourth quarter, it looks like real GDP is also growing well above a trend pace. So we'll take a look at that here in just a minute. So let's go to the next slide. So here's Here's the Atlanta Fed's GDP now forecast for the fourth quarter of 2020. That's the blue line in this picture. So this is the annualized growth rate for the fourth quarter as predicted by GDP now. The gold line there is the CBO's estimate of potential growth rate. It's a little less than 2%. So the blue line is way above that. Looks like at the right-hand side of this chart, it's right now their estimate is 8 to 9%, which is a ridiculously fast growth rate for the U.S. economy. What I like about GDP now is that it's just the data. There isn't any, or very little judgmental adjustment. It's just, based on the data that we have in hand right now, what would we expect fourth quarter GDP growth? And it looks like it's quite strong here. So that's helping us recover a lot. Let's go to the next slide. And labor markets are continuing to improve. Employment has rebounded far more rapidly than expected. And the main idea here is that many of the layoffs, there certainly were a lot of layoffs and unemployment skyrocketed, but a lot of those were classified as temporary layoffs, self-identified by the workers themselves as being on temporary layoff. If you want to read about this, you can look at this paper by Hall and Kudliak, which have emphasized that this temporary layoff is very uncommon in U.S. recessions, but this time around it's been a huge factor, and that's why the unemployment rate has come down so rapidly. Let's go to the next slide. So here's one picture that tries to get at this idea that unemployment has come down way faster than it did after the last crisis. The upper right-hand point in this picture is the peak, is normalized to the peak unemployment rate after the last crisis for the blue line, and after this crisis for the gold line and the green line. And then how fast did unemployment fall as you go to the right in the chart in the months after the peak? That's what this chart is showing. And the blue line is very flat and extends a long way out to the right. There are 2 years. It took 2 years just to get the unemployment rate to come down 1.2 percentage points after the last crisis. So that's what a lot of the forecasting community has in their head about what's going to happen this time around. It's going to take forever to get these high unemployment rates to come down. But that isn't what's happening at all. The gold line shows you the official unemployment rate declining a whopping 8 percentage points already. And we're only 7 months along here since the peak. And if you were willing to look at the adjusted unemployment rate, that's actually come down almost 12.5 percentage points already. So these are dramatic falls in the unemployment rate compared to what we saw after the financial crisis. Let's go to the next slide. And this chart tries to show why this is happening and how different the temp unemployment category is. If you look at, this goes all the way back to 2006, the gray areas are the periods of business recession. So the financial crisis is a gray area there for 2007 to 2009. You can see the official unemployment rate, the gold line, goes way up to 10% and then declines very, very gradually over the next decade. So it takes forever to get the unemployment rate down to the low levels that we saw in 2018, 2019. But the temp unemployment category, which is on the right axis here, was only 10 to 15% of the unemployed. When you go over to the right part of this chart, the temp unemployment category skyrockets up to 80% of the unemployed are identifying themselves as being on temporary layoff. It makes perfect sense because businesses viewed themselves as temporarily shut down while they're waiting for the pandemic to go away, and they wanted to keep their workers nearby so they could bring their workers back. And that's exactly what happened during the summer and the fall of 2020. A lot of these temp workers were recalled, but we still have an elevated level of temp workers at this point. And so that bodes well for the future of unemployment here as we go to the next slide. If you just think that those unemployed still identifying as themselves as on temporary layoff are just simply going to be recalled as these vaccines are rolled out and nothing else changes, the official unemployment rate would decline all the way down to 5%. even if you didn't think that, you think that's too optimistic, you could say, well, the temp layoff category is just going to return to a normal value, which would be something like 1 million workers at any point in time. Nothing else changes. You'd still get the unemployment rate to decline all the way to 5.6%. That's the median unemployment rate of the post-war era. So I would say, as far as a crisis goes, the crisis would be over at that point, and then you try to drive the unemployment rate down farther from that point. But it looks like you could get further declines in unemployment during the first half of 2021. Let's go to the next slide. This table here is trying to show how far ahead we are as far as recovery in the labor market. And the bottom line is in that last column there, we're about 49 months ahead of the last recovery as far as labor markets go. So that's a good 4 years. Shows you how different this shock is compared to the financial crisis shock. The second to last column shows the percent recovered on these various metrics of the labor market, which is the first column there. So in terms of hours worked, we're about 2/3 of the way back. In terms of civilian unemployment, we're about 64% of the way back. In terms of non-farm payrolls, we're about 55, 56% of the way back. So we're way ahead of where we would have been in the last recovery. It took 4 more years to get to these levels in the last recovery. So it's very different. And my main message is you can't use the last recovery as a metric for this recovery. Let's go to the next slide. Let me just talk a little bit about inflation expectations, and then I'll finish up and we'll be ready for questions. Next slide. So this is market-based. It wouldn't be a complete talk unless a Fed guy talked about inflation. So that's why I had to put the slide in here. But this is inflation expectations as measured by markets. There's a TIPS-based market that many of you are familiar with. And what I've done here is that Treasury inflation protected securities market, which gives you a read on inflation expectations every day. That is based on consumer price index inflation, whereas what the Fed pays the most attention to is personal consumption expenditures inflation. So those are 2 different ways to measure inflation. The CPI inflation tends to run about 30 basis points higher. So what I did here is just adjust all these expectations by 30 basis points in order to give us a read on what the market thinks PCE inflation will be over the next 2 years, over the next 5 years, and over the next 5 years after that on the blue line here. It doesn't really matter which one you look at. They were low in March, April. They declined dramatically. The 2-year one looked like it was going to be negative, so that their markets were predicting deflation and substantial deflation in March, April, but they've since recovered and come dramatically back to between 1.5% and 2% as you get to the right part of this chart. This is daily data, so this is the very latest. But my point here is that if you make this translation from CPI to PCE inflation, you could go still higher on this on these inflation expectations and still be consistent with PCE inflation being at the 2% inflation target. So I think we've still got more room to go here on inflation expectations. Let's go to the next slide. So these expectations have recovered from the market lows. The new framework of the Fed has probably had some influence on this, but the break-even inflation could go still higher and still be consistent with the Fed hitting its 2% inflation target on a PCE basis, or overshooting the target, which is what I and many others on the committee have talked about in order to center inflation expectations at 2%. So let's go to the next slide here. All right, so let's conclude. I'll open up for questions. This early arrival of vaccines, which I would put at kind of 10 months ahead of schedule, suggests that the global pandemic will wane during the first half of 2021 as fatalities fall off. So we'll be looking intently at the daily data for that in the weeks ahead. Monetary and fiscal policies have been especially aggressive. and the associated macro outcomes have been considerably better than what were originally projected as the pandemic hit us in March, April. The aggregate resources to fund consumption continue to be exceptionally high, real disposable personal income exceptionally high, well above the trend that would have occurred had nothing happened in 2020 except a continuation of 2019. So that suggests that the recovery in the first half of 2021 is on a good track, including better labor market outcomes as we go through the year. You've always got downside risk in a crisis, and as always, we have to be aware that the health part could take twists and turns, and we can talk about that more. So that's why you have to keep on top of this on a daily basis. But hopefully we'll be able to drive toward the end of this pandemic year and get back to more normal health outcomes and more normal economic outcomes. So I'll stop there and open it up for questions. Thanks very much for your attention.
Thank you, Mr. Bullard. We really appreciate your time with us today and the valuable information. We do have some questions that we would like to share with you and to get your thoughts upon. First of all, the first question is, the globe now has approximately $17 trillion in sovereign debt priced at negative interest rates. What are the long-term ramifications of negative interest rates, and how does the U.S. avoid those issues?
Yeah, it's been a stunning development to see this globally. Europe has followed Japan into a very low inflation, low nominal interest rate environment that has driven them to negative policy rates. This is, in my opinion, is not a good option for the U.S. Because of a different structure in the short-term funding markets. So I don't think we'll see this in the U.S., but the overall message that global interest rates remain very low and are expected to remain low over the medium term and possibly into the longer term is very significant, I think, for our ability to recover, which will be improved by that, and our ability to get back to normal. I do think that with the economy doing better in 2021, you'd expect a natural increase in longer term rates associated with that. So we'll see if that develops. You have seen 10-year trading over 1% here, but still these are extremely, even with that, these are extremely low rates no matter how you cut it.
Thank you. And with a return to robust liquidity and as well as record equity and fixed income insurance, do you now anticipate that the Federal Reserve will continue corporate bond purchases?
That program was put together in March, April as a concern that big companies would lose access to capital markets because investors would lose confidence that those guys had a good business plan to make it through the pandemic and not go into bankruptcy or default on their debt. But that, first of all, I think the idea that we would support those markets did work and brought some good market pricing into those markets. But it turned out that it's actually a good year for corporate debt, and a lot of companies actually were able to access markets, and I think investors were able to see, especially for big companies that have been pretty successful here during the pandemic, that there was no loss of access to markets. So I don't really think we need to be in there. We want the market prices, and we had some backstop funding there, but it hasn't really been needed, and now markets have long since returned to normal.
So do you think that the federal government will increase support for retraining, reemployment, and workforce development programs? And if so, through which funding vehicles?
Yeah, I don't know if that's on the agenda or not. The federal level worker retraining programs have been star-crossed, I would say, during the last couple of decades. There are many of them. They don't coordinate that well. Studies of them have mixed results on how effective they are. So I actually think this would be a great time to revisit and try to reorient some of those programs and see if we can get them to be more effective than they are. Maybe that'll happen here, but I haven't heard too much about that.
I don't know if you can see me, President Bullard, but as an economic developer, I'm grinning at the moment. I really appreciate your answer to that question and would wholeheartedly agree, and would love to see us move towards a more effective implementation of the programs that already exist, or at least the monies that are available for those programs. So thank you for that point. And I want to go back real quickly to the question before. Based upon that liquidity, do you see, as we are seeing from our economic development pipeline, companies now more adept and more able to fund long-term capital investment based upon their balance sheets today versus maybe where they were this time a year ago?
Yeah, I mean, I think for big companies that have access, this might, this is going to be a potentially a time where they really do make a lot of investments, especially you can see the light at the end of the tunnel for the pandemic. And a lot of these investments aren't going to come online till, for a year or 2 years or 5 years, depending on what kind of business you're in. So I'm expecting the low interest rates combined with the sense that the pandemic is coming to an end. I think that's going to lead to an investment boom going forward. Now, for smaller businesses, it's tougher. They don't have ready access to markets, and they have to convince investors to come back. But you might even see more investment on those dimensions as well. So we'll be looking for that in the months ahead.
Well, President Bullard, given the data that you showed on household income growth that's resulted from the PPP as well as other economic stimulus measures, would you recommend Congress pass any additional economic stimulus at this moment in time?
Well, I've been arguing caution on this all through the last several months because of these pictures. I think our hearts go out to those that are disrupted but aren't able to be kept whole. And so for those people, we definitely want to get them more resources. But when you unleash the Congress on it, they want to give money to all their constituents naturally, because they're politicians. And somehow we have to put some discipline around this and make sure that the money gets to the people who are actually disrupted, as opposed to piling on to somebody who wasn't really disrupted and then giving them even more income. I think a good question for all politicians to ask themselves is, are there better uses of this? If you're going to borrow and spend on something, maybe there are other things we can do. Both on the left and the right, they have agenda items that they'd like to fund. Maybe we should be funding some of those things, and simultaneously being sure that we're targeting the funding that's meant to repair the balance sheet of a disrupted household, that we're targeting that toward the disrupted person.
With the stock market remaining relatively strong based upon what's happened in the pandemic, in comparison to other economic indicators, what do you think has contributed to the stock market remaining strong and yet other indicators not showing that strength?
Yeah, I think that the market has called this about right the entire time. They understood that this was a temporary shock and not the same kind of thing as the global financial crisis, which was a more persistent, more permanent type of shock. So they could see that that eventually the pandemic would come under control. And since they look out over a long horizon, 5 to 10 years, they were valuing companies based on the profits that they could see out there in the future, even though some profitability might have been impaired during the pandemic. Now, for many of these companies, actually have had the best year they've ever had. And Walmart would be a great, I'm not sure if it's their all-time best year, but one of their best years ever. And many other companies have actually done very well, especially big companies have done very well during the pandemic. They've had good management. They've been able to adapt to the pandemic situation, produce their good or service. Some have been really badly disrupted, and airlines are a great example, but others as well. They were just in a business that you just couldn't do that much. But for many, they've done very well. The other thing I would say about this is during the global financial crisis and its aftermath, financial wealth fell dramatically. So people felt a lot less rich. They saw their lifetime savings decline in value if they were near retirement, and they had a lot of this caused a lot of people to pull back on their consumption and on their retirement plans. This time, that didn't happen. You have housing prices continuing to go up. That's a big component of household wealth. And you had the stock market continue to go up. And in fact, wealth is at an all-time high. So that's another factor that's very different this time than last time. And I think once we can get the pandemic under control, U.S. economy is actually in great shape to do very well going forward, and hopefully absorb a lot of those workers back into the workforce and get them up and running again.
So based upon the recent events that we've all been obviously paying a lot of attention to, what effect, if any, do you think single party control over the White House and both houses of Congress will actually have on the economy over the next 2 years?
I think it does change the calculus some, but I wouldn't overstate it. I think a 50-50 tie in the Senate means that it's still very hard to do anything for either party, and you do have the filibuster. It's not going away, so I don't think it's a blank check for the Democrats, but they will be able to do more than they would have otherwise, and possibly to force through some provisions that they wouldn't have otherwise. I think for markets, they're very cold. They're probably just looking at the idea that there'd be even more stimulus coming. I don't like the word stimulus. I would say pandemic relief, that there would be more coming in the new Congress, but we'll see if that actually transpires or not. My general experience, I would say, and maybe you guys would agree, but when parties get control of all three branches, they start to fight within the party in ways that you might not expect, and so we'll see if that happens. We'll see if that happens this time. It's like the dog that catches the car, and then once you actually have it, you're not that sure what to do with it. So we'll see if that happens this time. There are obviously factions in both parties, huge factions in both parties. So we'll see what happens here.
And this is our last question, President Bullard. You alluded to this a bit, I believe, early in your presentation, but given the unprecedented policy steps that have been taken to respond to this pandemic the last 12 months, in your opinion, has the economy fared better or worse than you would have expected?
The economy has performed very well compared to expectations in the March-April timeframe. And a lot of that has come through an outstanding policy response and oversized policy response. It was designed for an even bigger pandemic than the one that occurred. So as big a tragedy as this has been, there are pandemics that could be even more serious and kill even more people. And that's what people were worried about in March, April. And they were thinking GDP down 10%, millions dead. And so, compared to that expectation, we've done way better than we could have anticipated at that time. But I think the policy response was very fast. The FOMC, in which I'm a participant, met on a Sunday, even though we had a meeting scheduled for Tuesday and Wednesday. That's how fast things were moving. We got going on these programs. We stemmed an incipient financial crisis, and the fiscal side, despite dysfunctional politics, everyone jumped on board and got programs going almost immediately, got money out the door almost immediately. And so I think there's just a lot to like about the way the country responded to the pandemic in economic terms. And that has helped us dramatically. And now we're in pretty good shape as we're eyeing the end of the crisis here.
Well, President Bullard, based upon your presentation today and your thoughtful answers to the questions, first of all, we want to say thank you. Thank you not only for today and sharing your wealth of knowledge that you've been able to do with us this afternoon, but also we want to thank you for your service. I think history will reflect upon the last 10, 11 months as one of the most tumultuous times, obviously, in our country's history. And yet, as you mentioned, you and your fellow members of the Federal Reserve moved ably, quickly, adeptly, and continue to make sure that you have your finger on the pulse of this economy so that we can continue to keep as few people as possible from hurting. So thank you for what you have done as well as what you're going to do. And I also want to thank our audience today for the very insightful questions that you provided for President Bullard. On behalf of everyone here at the Little Rock Regional Chamber of Commerce, thank you for joining us. And we want to say one more special thank you to our presenting sponsor, Arvest Bank, Jim Cargill and your team, as well as Ed Choate, our supporting sponsor, and his team at Delta Dental. President Bullard, we wish you a most prosperous 2021, a little bit of downtime and a little bit of rest and relaxation as we hopefully put this pandemic in the rearview mirror. Thank you so much for all that you do. We appreciate you. Have a great day.
Thanks very much. Thanks for having me.